Welcome to This Explainer. Look, if you're trying to scale up your operations without completely draining your bank account, you are in the right place. Today, we're breaking down the ultimate playbook for acquiring critical business equipment while fiercely protecting your cash flow. Let's jump right in by confronting a trap I see so many businesses fall into: the over-leveraged nightmare. You know how it goes. You take on massive debt to fuel rapid growth, flying a bit too close to the sun. It is so tempting to chase those big opportunities by borrowing heavily, but doing it blindly, that can completely paralyze your cash flow and lock up your flexibility for years. To untangle all of this, we've broken our playbook down into 6 structured steps. We'll start with avoiding that over-leveraged trap, move into flexible financing models, compare operating versus finance leases, look at maximizing your tax deductions, check the impact on your financial statements, and finally, monitor your financial health. All right, part 1, avoiding the over-leverage trap. We're kicking things off with a pretty stark warning from the Phoenix Strategy Group about the absolute limits of traditional borrowing. Think about what it actually takes to scale up your modern tech infrastructure today. It's a massive cash drain, right? If you just buy all those servers and laptops outright, tying up your working capital in stuff that literally loses value the second you plug it in, it is incredibly easy to overextend yourself. You buy the gear, but then you've got nothing left in the tank for hiring, marketing, or just surviving a random economic storm. So, what's the alternative? Section 2, Flexible Equipment Financing Models. Let's look at how leasing can actually act as the perfect antidote to that trap. Our U.S. sources point us straight to something called a fair market value, or FMV lease. And honestly, this is the absolute perfect tool for assets that get outdated fast. We're talking laptops, servers, specialized software. It's kind of like leasing a car. At the end of the term, you just hand the equipment back and upgrade to the newest tech. No way do you want to be stuck with a supply closet full of dusty, obsolete hardware. But what if your team expands? Say you suddenly need 20 more laptops 6 months into a lease. Well, that's where a co-terminus add-on comes in. It's a fancy word, but it brilliantly links your new lease to the old one so everything terminates on the exact same date. No juggling a dozen different return schedules. The whole shebang stays perfectly synchronized. And the actual procurement process is surprisingly smooth. Take a look at how a leaser handles this from quote to activation. Your chosen supplier simply creates a quote, the leaser buys the equipment, the supplier installs it right in your office, and boom, your lease is activated. It takes all that heavy lifting completely off your internal purchasing team. Okay, moving on to Section 3, Operating versus Finance Leases. Let's break down the critical differences between the two heavyweights here. So the big choice is between an operating lease and a finance lease. Think of an operating lease like a long-term rental. It's absolutely perfect for a fast-growing tech startup that needs to keep their tech bleeding edge. A finance lease, on the other hand, is a lot more like a traditional loan. That's specifically designed for an established company, like a construction firm buying heavy machinery, where you actually want to own the asset at the end and you're willing to take on the risk. But if you do go the finance lease route, you really need to wrap your head around amortization, because those expenses are front-loaded. In the early years, your payments are going heavily toward interest, not the principal. You've got to forecast for this, or else you're going to get a nasty surprise on your income statement right during your high-growth periods. Which brings us to the aha moment. Section 4, Maximizing your tax deductions. Lean in for this one, because we're exploring how 2026 tax codes can legitimately slash your equipment costs. According to U.S. Bank, Section 179 of the IRS code is a massive game changer. For the 2026 tax year, businesses can expense the full purchase price of qualifying equipment up to a staggering $2.56 million. Literally, you can write off the entire cost the very same year you install it, instead of agonizingly dragging out the depreciation over a decade. And it gets better. Bonus depreciation has been reinstated. So in 2026, you can deduct a massive 100% of eligible new or used assets in year 1. I mean, think about that. That is an unbelievable tool for instantly freeing up cash when you're making major capital moves. But actually, scratch that, it's not a free-for-all. IRS rules dictate a very strict order of operations if you want to stack these massive benefits. Rule number 1, you absolutely must max out your Section 179 limit first. Only then can you apply that bonus depreciation to whatever balance is left over. Let's put some real math to this to see the magic happen. Imagine you buy $3 million worth of equipment. First, you take that max $2.56 million deduction from Section 179. Then you hit the remaining $440,000 with the 100% bonus depreciation. If your company is in a 21% tax bracket, combining these yields an immediate $630,000 in actual cash savings. That drastically lowers your true out-of-pocket cost. Pretty wild, right? All right, Section 5, Impact on Financial Statements. We need a quick reality check on how these leases actually look to your accountants, and more importantly, your lenders. So, under the ASC 842 accounting standard detailed by Crestmont Capital, the rules changed. Almost all leases now require you to put a right of use, or ROU asset, and a corresponding liability right there on your balance sheet. This major rule change effectively killed that old off-balance sheet loophole companies used to make their debt look magically lower than it was. When you compare these side by side, the differences really pop. An operating lease gives you this beautiful, clean, single straight line expense on your income statement. It makes forecasting a total breeze compared to the messy, split expenses of a finance lease or an outright purchase. But here's a really fascinating wrinkle, what we call the EBITDA effect. Since the interest portion of a finance lease isn't an operating expense, it actually gets excluded when calculating your EBITDA. So on paper, your company's operational profitability can actually look higher than if you used an identical operating lease. It's a clever little strategic nuance you should absolutely discuss with your CFO. Finally, let's wrap up with Section 6, monitoring your financial health, because we want to make sure this new, capital-efficient growth stays safe and sustainable. To keep your leverage in check, you need to religiously track this rule of 3. Number 1, your debt-to-equity ratio. How much are you relying on creditors? Number 2, your debt service coverage ratio. Does your income actually cover your debt payments comfortably? And number 3, your interest coverage ratio. Can you handle the interest without breaking a sweat? The experts at Phoenix Strategy Group put it perfectly. A balanced approach ensures smooth growth without overextending your finances. By constantly stress testing these precise metrics against your industry benchmarks, you find that sweet spot, that perfect mix of debt and equity for your unique growth stage. It keeps you proactive and safe when the market inevitably shifts. So, there you have it. You now understand the power of flexible FMV leases, those massive Section 179 tax hacks, and the reality of the accounting rules. You literally have the playbook to safely accelerate your business without falling into that dreaded over-leverage trap. The only question left is, how are you going to structure your next major equipment acquisition to guarantee smart, explosive scaling? Thanks for joining me on this explainer, and we'll see you next time.